Greetings, everyone, and welcome back to another episode of The Closing Bell. First, folks, we got to talk about housing. Then we got to talk about is the stock market at bottom, and then of course we've got earnings to talk about. We got some big ones coming up after bell, including AMD. So it's gonna be pretty fun. But first, I do want to touch on the housing market because there are a few things that are coming up in the housing market that I think are cause for at least some concern. Now, we've been talking about housing on this channel for a while now, okay? But today we really got to talk a little bit more about some of the things that have started occurring. Back in January, we really talked a lot about how, look, when the 10-year Treasury goes up, hits 3%, we're going to see mortgage rates in the 5 to 6% range. This is what slowed down the housing market in 2018. The housing market lost 12% in the span of 2 months once home buyers reacted. Now, today, things are a little different. We've got a lot of excess demand in the home buying market. And so what happens is when interest rates go up 1%, we tend to see a reduction of 10% in purchase power. We know this. This is old math at this point. We learn about this not only on the channel, but of course in the programs on building your wealth with real estate and do-it-yourself property management and rental renovations. But we go much deeper than that. And for example, one of the things that we got to know is that if we have excess demand right now of 30% and interest rates go up 3%, cool. Well, now maybe we have an equal level of supply and demand, right? The question is, could we potentially overly compensate for excess demand, end up with now more supply than demand, which leads prices to kind of start curving a little bit? And does that potentially lead to fear? Well, 10-year Treasury right now sitting at a 2.97%, moving back up on that neighborhood of 3%. And on top of that, we just got a report here that in Vancouver, they're now seeing evidence of a sharp decline in their housing market. Now, usually when we hear sharp decline, like there are many different matrices that we can look at for, a steep slowdown or whatever, right? And what they're talking about is that seasonally adjusted home sales in April declined sharply by 22.8% compared to March. This is now the third monthly decrease in a row. The concern with this is that if you're not selling as much inventory as you used to, you start basically building up inventory more. And that means you start getting into the direction of oversupply while at the same time as having higher interest rates, higher costs, lower purchasing power. There's really only one direction that prices go after that. Now, this is the third monthly decline that they've seen in the Metro Vancouver housing market, third in a row. Now they see that on the supply side, the number of properties listed for sale in April shot up 5.3% in March. That is now the fourth monthly increase. And you're kind of seeing murmurings of that same thing happening throughout the country, where now you're finally starting to see housing supply kind of do this, like the slow kind of S-curve ramp, right? And you're getting the reverse, like the slow kind of S-curve to the downside ramp of price appreciation and sales. So those are things to keep in mind. And certainly they're entirely likely to cross. But anyway, Bloomberg is also, and this is the other thing that I've been talking about regularly that you have to watch for, is it's not so much like what's actually happening that scares home buyers or whatever. It's like literally, what are people saying on the internet, right? Now, that could be totally wrong. It's entirely possible the housing market soft lands, fine. We have higher rates for a couple of years. They'll come back down. I widely expect rates to come back down. I think people are going to have a great opportunity to refinance down. And they probably, not financial advice, shouldn't like pay money to get a higher or a lower interest rate. Just take the higher rate, take the credit, and then refinance in the future. But now you've got Bloomberg saying that in March, a measure of U.S. housing affordability fell to its lowest level since, wonderful year to compare to, 2008. Housing is only getting less affordable in the coming months. The fixed home buyer index fell to 124 in March from 134 the prior month, according to the Association of Realtors, with declines signaling that homes are becoming less affordable. And that's no surprise. And then they go on to give some examples of how much it costs now for an average $400,000 home versus not. And that's not so much important. What's really important is that we know purchase power declines 10% for every 1% that we see rates go up. So these are definitely things that we want to pay attention to in the housing market, mostly because that could also trickle over to the stock market. If we start seeing people's impression of wealth decline because their underlying assets have lost value, then they're less likely to spend like loonies on travel or goods and new refrigerators or solar panels or Enphase inverters. I hate saying that. Okay, I hate saying that because I love Enphase, but let me just tell you, and I might be really early with it, But if people's home values are going down, I guarantee you they's not putting on solar panels, at least not at the rate at which they were previously, right? Like somebody's still going to buy solar panels. It's not like these companies are going to have their business go to zero. But yeah, expectations will be, misses. Anyway, my thoughts. Okay. Now, next thing that we need to talk about, and we've got about 4 minutes to go. There are 5 graphs that tell us we are not yet at the bottom of the market. And one thing that might potentially signal that we're at the bottom of the market is that there is now a wonderful coupon code that's expiring May 15th, link down below for the programs on building your wealth. We're going to have a large price increase this time coming up in the middle of May because we're going to have a content drop. Price is going to go up thanks to inflation. And it's coming. So stay tuned. Now, one of the things to look at is, have we hit the bottom of the market? And so I want to show you 5 charts here. I think these are really interesting. I picked these out this morning. If I can hit the button correctly, there we go. Okay, this is chart number 1. I'm gonna have to hide myself here for a few seconds. But so this is these are sort of bottoms charted here, right? So you see some bottoms in the market. You see the S&P is the black line, and so look when you kind of get these S&P declines on your black line. And the blue line corresponds with these S&P declines almost regularly. And so you hit these crazy bottoms over and over and over again every time you get these big declines. And so this is a measure of the net number of stocks declining, not yet at extreme levels. So that's their definition. You peg a definition of what extreme levels is, and then you see net stocks declining, right? Okay, cool. So we have not actually yet today hit like a super low. If anything, we're kind of like over here at like the end of 18, but we haven't hit like the dead end of 18 yet, which was like really bad, right? Okay, cool. So that's that one, which says, hey, things could actually still get worse. Here's one: excess liquidity not being supportive. So excess liquidity is like cash printed minus economic growth. The difference is deemed excess liquidity. And so they put global markets over this. And usually what you see is you see excess liquidity kind of, the blue line here, which is your excess liquidity line, kind of over here, it's tracing as you get this liquidity going down. You can have these shorter term drops to the downside. I think this is probably one of the most blurry, but what you see here is the stock market on the right side, stocks going down, excess liquidity going down. But, are we at the dead bottoms on this one? I don't know. It looks, who knows? Maybe we could go down a little bit more, but we're definitely on that lower side, right? Kind of like that triple bounce on the QQQ. Here's another one: net number of stocks making new lows. So this one is actually bad. Like this one says, no, we're not even close to a bottom yet, because look at this. You have new 52-week highs minus new 52-week lows, which would imply like if everybody's like a ton of stocks are hitting 52-week lows, it means there's broad-based pain compared to the index. And so obviously in down markets, you would expect broad-based pain. But look at that. Like we're over here. We haven't even hit some of those levels that we've seen in the past. Now, there could be other reasons for this and such, but there are 2 more here. Sentiment is closing in on the contrarian territory. This was actually kind of suggesting via bull-bear spreads, often in options, that we might actually be kind of getting close to a bottom. And this one here says, hey, long short-term volatility doesn't show that complacency yet, but maybe there's some room to go. So I would say out of these 5 charts, we probably have 2 or 3 of them that are like, yeah, no, we're pretty damn close to the bottom. But a couple of them are like, I don't know. There could still be that like panic push. We're pretty damn close, but there could still be that panic push. Now, personally, I think this is all going to end up being one of those green dots, aka a bottom. I believe that the Fed's going to be faced tomorrow with a negative quarter of GDP, and they're going to get laughed at if they try to call the negative quarter of GDP transitory and don't finally recognize some of the tightening that they've already been implementing in the market. So we'll see. My thoughts. Anyway, let's get to the closing bell. All right, closing bell, folks. Here we go. We'll see how things ended. We'll get to earnings.
Toward the end of the session, energy and financials are your best performers. Consumer discretionary and staples are your worst. NASDAQ is going to close out in positive territory. Dipped negative a few minutes ago. It's up about 0.25%. So kind of a split for big cap tech today. Small caps doing exceptionally well. That does it for me here on Closing Bell. See you back in New York tomorrow. I'll send it into overtime now.
All right, there you go. So what do we got? Well, take a look at it here. You've got the Dow Jones up 0.2%. I'm actually surprised we're green across the board today. And look at that. a 3x outpacing of the Russell 2000 over the NASDAQ. Usually that's a little bit of a sign of risk on. So you got the Dow up 0.2, S&P up 0.48, NASDAQ up 0.22, Russell up 0.67. Really fascinating. Now, we got to look at El Calendar, okay? So El Calendar says that we've got AMD coming up in 15 minutes, Airbnb and Starbucks and Lyft coming up in 5 minutes. MicroStrategy, well, they're basically just Bitcoin. AIG, okay, and some other Fulgent Genetics and some other companies. But we really want to pay attention to those biggies. And boy, I've got like 12 earnings transcripts that I still have to put on a video for y'all that are really insightful. So stay tuned for that in a future video. Actually, I've been having a lot of fun while I pull up these earnings here. Today, I know this doesn't sound like maybe it'd be a fun thing for normal people, but negotiating an office. So it's going to be really cool to like get out of the work from home. You know, when I went on Yahoo Finance and I got ambushed, no, I'm just kidding. I like them a lot. When I went on Yahoo Finance, they brought up one of my tweets. They're like, oh, Kevin, you don't like work from home anymore. You've been doing that for 13 years. I'm like, that's right. Give me the F out of here. So we'll see. It's going to be fun. All right. So let's see here. Next, while we wait for earnings, the first ones coming out are Airbnb, Starbucks. Oh, Airbnb's out. Never mind. Okay, they are forecasting a beat. That's good. Revenue comes in at a beat, 1.51 billion versus 1.45 beat. The guidance coming in at a midpoint of, quick math, 2.08 versus 1.97. That's a beat. Adjusted EBITDA, huge beat. Holy crap, that's almost a 3x beat on adjusted EBITDA, 229 million versus 75 million. This is a phenomenal beat. That's really good. I mean, it just shows. I mean, nights and experiences booked 102 mil versus 98. That's like a quadruple beat for them. This should be up 5 to 10%. Let's see here. Okay, it's up 5%. I'll take it. Wow. Yeah. No, that is phenomenal. Keep in mind that like they're basically right now sitting at IPO level. You know, it's crazy. So hey, you know, we'll take it. Let's see if we can. Oh, it's gonna play it like that. Okay. I'll fix this later. But anyway, okay. So Airbnb bobbing around, sitting at about that 3%. Airbnb sees quote. Listen to this one, okay? This is the kind of stuff we want to be paying attention to. Airbnb sees quote substantial demand for travel exceeding estimates. Don't mind me going to Florence this month. I'm super excited, actually. This is going to be the first time that Lauren and I have gone on a trip since 2019 without kids. And those weren't even vacation. I mean, we kind of tried to turn them into like little fun parts, but that was back. I used to do seminars back in 2019. Anybody here in the chat been to one of them? That'd be crazy. But it was back in 2019. It'd be like, let me teach you about real estate kind of stuff. It was really cool. But I did those all of 2019 leading up to the pandemic. My last one was February of 2020. Kind of crazy. But anyway, we haven't traveled since then. So we too are like, yes, we would love to travel. So that's Airbnb for you. Not a surprise. Waiting on Starbucks, Lyft, and AMD next. But let's go. I mean, that is honestly, that's bullish on Airbnb here. I will quickly, though, I want to look at, you know, this morning in the Course Member Live, we made a spreadsheet that's really, really cool. We were working on like beta weighting portfolios and evaluating sort of where companies fit in relative to each other, which is really fun. A great way to kind of start research. You know, still at like 152, they're sitting at, they've got a beta of like 1.17, which I think should probably be higher, although that is adjusted. But their PE for 2022 is like 90. You know, their growth's like 23%. So you're paying a pretty penny for Airbnb. You know, who knows? Maybe it could be a trade in the short term here after the Fed meeting, and maybe it goes back to 170 or something like that, 180, whatever. But it's still on the little pricey side. But I will say, you know, Lyft, it's good for the market, right? Lyft beat 875.6 mil versus 844.5. They had a net $24 million income, and they had a loss projected of 21 mil. Active riders comes in at a miss 17.8 million versus 18, but it looks like they were able to charge more for those. They had Q1 revenue. Yeah, absolutely. That's a beat. Yeah, that's really good. That's really good. Let's see how Lyft is doing. Lyft up about 2%. You know, that miss on active riders, probably not like superb. All in on Disney. You know, I'm so tired of like the woke crap, like becoming cancel culture, right? It's like I'm like purposefully like not selling Disney stock because like I will not participate in cancel culture. Like if anything, I want to add more to it. It's look, get over the politics. It's a great freaking company with very, very high margins. So if we want to have a political discussion, we could do that. But yeah, Airbnb revenue climbs on record nightly bookings and higher prices. Lauren made me iced coffee. Shout out to Lauren. Hey, when's she going to post to her channel again? Lyft up now, what, 3.4%? Airbnb up 5 or so. Good. Good. Let's go to QQQ. Should I hodl cash to buy real estate, or is stagflation going to screw things up? No, you get a reduction in real estate prices. You buy. Stay woke, go broke. I know. Yeah. All right. So where's Starbucks? Still no Starbucks and AMD. AMD comes out in 9 minutes, though. Starbucks is late. QQQ moving in the afters. Let's go. Look at that. Did we have a 5-minute close above the line? Please tell me we had a 5-minute close above the line. Damn it. Look at the closing bar. Come on, man. It's like that would be the good omen. That's what we need. We are not. I don't know, man. I can't see it going lower than this. I think we're all gonna we're gonna kick ourselves in 6 months, going, damn it, I wish I bought more then. I'm gonna be like, yeah, but I wish I went into margin. Well, come on, let's get those earnings, S-Bucks. What are you doing? I just bought a Starbucks yesterday. I almost got an office next to a Starbucks. I thought that would be kind of cool, but you know, this one we're negotiating now is a little more entertaining. A little bit. Yeah. Hey, landlords, if you're watching, yours sucks. There's a better one I'm looking at. Okay, so Lyft riders up 31.9%. Lyft reports 2.2 billion of unrestricted cash. Wow, dude. How do they have that much freaking money? Like, it's just hitting me for a moment. Like, what? Lyft has $2.2 billion? How much staff does Lyft have anyway? I mean, like, most of the people are 1099, so you just need like programmers and customer service. How many employees at Lyft? 4,400? Holy crap. How do you have 4,000 employees? Okay, dude. $10 billion company. Wow. Okay. All right. Come on. AMD is a big one. I want to see that miss on the chips. But Starbucks comes in. Comp sales up 7%. Estimate was 7.51%. North America beats 12% on the beat here. 8.66% was the expectation. International comes in minus 8% international. China down 23%. Dude, China is in a recession. You do not listen to the CCP. CCP, please don't come to my house, okay? We can be friends. We can talk about this. But their numbers are cooked. Dude, holy crap. China, Starbucks' China sales down 23% in Q2 versus negative 6.5% estimate. Let's see here. Revenue comes in at 7.64 bill, 58 cents of EPS. Adjusted EPS missed by a penny. That's really interesting. China's, let's see, but don't worry. The Chinese government says the slowdown is transitory. Oh, I'm an asshole. Starbucks sales down 23% in Q2 versus negative 6.5% projected. But don't worry. Projected. But don't worry, the Chinese government says the slowdown is transitory. If you want to like that tweet, make sure to follow me on Twitter at RealMeatKevin. Okay, net revenue actually comes in with a beat. So net rev comes in at 7.64 billion versus an estimate of 7.62. Okay, but they still missed by a penny on EPS. All right. Oh no, now they're saying it matched EPS. All right, whatever. So QQQ is actually up at 320. It's actually moving positively here on all this travel news. No recession talk here, but that's a huge miss on SBox from China. And I mean, obviously, like there's going to be an international factor too for Russia. AMD, oh my God, they raised their estimate. What, dude? That's like a 10% beat on the estimate. Gross margin 54%. They're raising prices so freaking much that that inflation is helping them. What? Revenue beats. Computer and graphics revenue comes in at 2.8 billion. The estimate was 2.67 billion. They had capex of 71 mil, less than expected. Adjusted EPS of $1.13 versus 92 expected. Huge beat. Huge beat on the bottom line. More than 10% beat on the top line. Revenue 5.9 billion. That's a 10% beat on the top. It's a beat on the bottom. It's a beat on the forecast, dude. And everyone's pricing this market into a recession, dude. It's a triple beat, man. They're raising prices so freaking fast that they're not even worried about inflation. They're just like, yeah, we'll take your inflation, raise prices. Holy smokas. Barron's wrote an article about how China's economic pain could help avoid a global recession. Interesting. I will more than happily react to that. China's economic pain avoid global recession. Wow. AMD up about 4% now in the afters. It's actually kind of nominal for the kind of beat that it is. It's a really good beat. Oh, wow. That's literally what the title is. Okay. All right. I'm going to sign in here and I'll find out. Wow. Look, I mean, the North Americans are spending money. The Chinese are not. Wow. What a surprise. If you've listened to this channel, just like literally one day out of the last year, you've probably heard me say that. And if you've been here, every other day or daily or a couple times a week, you're probably like, yeah, it kind of has been saying, don't bet on the Chinese consumer. I'm like, no, like you don't need to be hit with a brick on that one. Well, you just did. I mean, that's obvious, but we'll see. I mean, who knows? Maybe it'll get better. It don't look like it, but maybe it'll get better. So yeah, that's an oopsie doopsies. 23% drop. I mean, that's almost 4 times the drop they were expecting. It's terrible. Operating margin for AMD comes in at 31%. The estimate was 27.4%. Starbucks opened 313 new stores in Q2, ending with 34,600 globally, 51% co-operated, 49% licensed. Huh. Interesting. Okay. Wow. That's really very, very interesting earnings here. Let's take a glance at this Barron's article that somebody here is talking about. I'm going to pull it up together so we can look at it. We'll react to it on the fly. All right, and just take me 1 second here. It's actually sounding like it's going to be a good one, but you'll have to download. Hold on 1 sec. Okay, cool. Now, password. Oh, it's so exhausting. They just log you out all the time. But it's okay. I have a password manager. Okay, there we go. And one more button push, and then we're going to look at it. Got it. So efficient. Not. It took forever. Okay, so there we go. All right, friends and family, today we are going to react to this article together because a member of our beautiful live stream community has asked us to react to how China's economic pain could help avoid a global recession. This comes after me suggesting that China is hiding the fact that they're actually in a recession. It also comes after the fact that Starbucks just reported that China's sales are down 23% in Q2, Starbucks China sales. That's versus the 6.5% projected. That's almost 4 times as bad as projected. But don't worry, folks. The Chinese government says the slowdown is transitory. So, with that said, we need to look at this article from yesterday evening about how China's economic pain could help avoid a global recession. Now, I have not read this, but I will say I'm like, huh? Like, they definitely got me with the title because I'm like, I'm not sure how the second largest economy in the world having a slowdown could somehow avoid, help avoid a global recession. But unless they're talking about like year over, the only thing would be like, oh, but it started being bad in like the second half of last year. So it's going to be such a bad comp in the second half of this year for the globe that if we were thinking we're going to have a global recession in Q3, Q4, well, we're going to be lapping bad comps for China, so we'll actually average positive. That's like the only like twisted mental math I could anticipate, but let's see what they say. The dire state of China's economy doesn't bode well for the rest of the world, but some strategists say it could help prevent a hard landing globally. Ooh, by forcing central banks to change their playbook. Oh, well, now that is actually interesting logic. Hey, look at all this like negative growth from China. They're actually going to be the ones who suffer while supply chains then are able to catch up. Maybe if we're buying the same things. No, that sucks for the Chinese people, but that is also largely in part due to the terrible decisions to overbuild with ridiculously loose real estate financing, and then all of a sudden come up with a 3 red line policy and basically rug pull all the real estate developers. You know, that's kind of their fault. But anyway, there is no sugarcoating the economic situation in China. Lockdowns to fight COVID-19, whose effects aren't yet reflected in official data, are causing a severe pressure, according to a survey of more than 1,000 firms by China's Beige Book. They do a Beige Book just like our central bank. All right, let's see. Virus outbreaks up. Okay, growth in revenues and profits from manufacturing, retail, and services is already slowing. Even more troubling. Hiring took its first big hit since the initial COVID outbreak in 2020, as companies took on fewer staff and wages dropped. Well, yeah, I mean, if you're locked down, what are you going to hire for, you know? Companies also demonstrated little appetite for credit. This is something that the Chinese people are really smart about. The people are smart about this. They are a cash frickin' culture. It's like no debt. I mean, they have debt. Don't get me wrong, but like, especially when times are leading to like, oh, things might get tough. No debt. It's really smart. Like, it's good. Like, that's. I wish we always had that kind of discipline. That's smart. Companies also demonstrated a little bit of appetite for credit. Right, both borrowing and bond sales dropped, according to the Beige Book, a troubling sign for investors. The focus on Beijing handles the outbreak is obviously a big deal. Okay, so what about the central banks? What are they suggesting? And sorry, Bloomberg or Barron's website does this stupid bouncing thing. Anyway, China's trouble come as other major economies face problems as well. Europe is grappling with the economic fallout of war, spiking food prices, fuel prices, driving up the cost of living. U.S. is growing tighter because of the Federal Reserve raising rates. Ironically, a soft patch in the global economy creates a silver lining because even if it will be uncomfortable for risk assets, it offers the best opportunity for a soft landing. That is noted. The deteriorating global outlook for demand could keep central banks, including the United States Federal Reserve, from pushing interest rates to restrictive levels, providing some respite to the bond markets. Now, that is an interesting thesis. We can we can kind of prod for that tomorrow to see how much does Jerome Powell actually care about a slowdown in China here. My guess is like right now, not much. But maybe when they have to make that decision, hey, do we go from 1.9 to 2.5? Maybe that decision slows down for them because of China. Do I really think they're not going to go 50 because of China? Like, we're getting our 50. All right. So economists cited strong balance sheets, pent-up demand for services, and staff shortages, encouraging labor hoarding, a factor that could bring higher wages and easing pressure on consumers from inflation. Right, but then people are also spending more, as reasons they aren't convinced the difficult economic situation will morph into a global recession. Okay, that's an interesting argument. I don't know how I feel about that one. I mean, rising wages do increase the capacity for us to pay more, right? and continue to buy things that otherwise maybe we would start sacrificing on. But anyway, Fed moves are unlikely to induce a recession this year. I think it's already too late for that one, but okay. U.S. earnings are still solid, true. And China could shift from a drag on the global economy to a positive factor as the country's efforts mitigate a slowdown kick ahead of the 20th Party Congress this fall. Okay, interesting. So they actually kind of are more saying, hey, we think we'll see a pickup this fall from China, somewhat of kind of implying that lapping of GDP that I first alluded to at first, which is, or not alluded to, I said it, which would be like, hey, like, you know, if China starts picking up, it'll actually, their GDP will look positive compared to the pain of last fall and last winter. And U.S. earnings still strong. So it's an interesting argument. I have to say, I think it's a little bit of a reach to suggest that the Federal Reserve is going to give two craps about, well, again, I hate to say it, China, when, you know, when we have so much inflation at home. So I'm not convinced. I remain unconvinced, but we shall see. Anyway, that's that Barron's article for you. Meet in the middle, 37.5 BP height. Yeah, they don't do that. It's because they're ranges. So actually, ironically, when you get a 50 BP hike, you probably in practicality get a 37.5 basis point hike because usually you trade within that range. So these are ranges. So when the FOMC conducts business at 0 to 0.25%, you're probably seeing most of the transactions occur around the, you know, like the 0.1 to 0.15 in that midpoint. So you kind of do get that anyway. Isn't tomorrow just a tease of what's to come? Not really. I think, you know, tomorrow's a big day. Yeah, if we get 25 tomorrow, buy everything. Although then it also makes you wonder, is the Fed like, oh crap, we actually are going into a recession? You know, no, I don't remember my passwords. I use a password manager. Anyway, okay, let's take a look at after hours a little bit here. So AMD's only up 3% and Starbucks is flat and Lyft went negative. How does Lyft go negative? Lyft says consumers are spending despite inflation. Let's go. Yeah, I mean this is what you want to hear. Not great for inflation, but it's great for you know, recessionary concerns. And consumers are still spending. Airbnb is only up 4%. QQQ is pretty much flat in the afters here, about a quarter on Starbucks, AMD 3.5%. What was the other one? No, Airbnb, AMD, Starbucks, and Lyft. No, they're all right here. Starbucks, Airbnb, Lyft, AMD. Yeah, all four of them are right here. Okay, what else is moving? And let's see how the things went on the day. Oh, Dave & Buster's? Is Dave & Buster's really down 4%? Well, let's just see here. It's going to be a while before the markets care about quantitative tightening because you got to get through the Fed repo market first, which is probably going to take a year and a half before it actually tightens. So I'm not so personally concerned about that. All right, let's see here. I see zero news from Dave & Buster's, so I don't know why Dave & Buster's would be showing us down 4% in the afters. Maybe it's just a glitch. Let's just see. Somebody's asking if I'm losing weight. Yeah, I am, which I'm really happy about because I started running again like 4 miles a day. Thanks for noticing. I can't believe Dave & Buster's is only a $2.2 billion company. Like, I want to like own them and like rebuild them. Like, they could be so much better. Oh well. What are you gonna do? All right. I don't see any news about Dave & Buster's. And Google's after hours doesn't show that they've actually moved. So whatever. Okay. I'm bored now. Anyone else? You can still drink full milk if you want. It's funny you call it full milk. Like in America we say whole milk, but in Germany we say full milk. So are you European? But anyway, I actually do. I actually do drink whole milk. I love my fat. See, ironically, okay, and I'm not trying to get on like a nutrition diatribe here, but people, ironically, fat, ideally not saturated fats. Ideally, you get unsaturated fats, especially your omega-3s and your 9s, which everybody in America is like basically deficient in omega-3s. But anyway, fats make you feel full longer. So there are a lot of people like, oh, I'm a diet. I'm just not going to eat fats. I'm like, dude, give me salmon, give me nuts, like load me up with the fat because then you feel full longer. Per calorie, or I'm sorry, per gram. Yeah, per gram fat is two and a bit times as calorie dense as protein or carbs. Anyway, okay. Okay. Tequila shots. Dude, tequila shots are great for weight loss, man. Stay away from the Mai Tais and go for the straight tequila shots. It's like the diet, stuff. Actually, vodka, I think, is a little better. I think tequila is like 90 cal a shot and vodka is like 70. But, that 20 cal is not going to make a difference. That's like the tip of a Hershey's Kiss. Kevin's nutrition lesson over.